Is Murabaha halal or haram? Have you ever wondered about the rules surrounding Murabaha in Islamic finance? Today, we will break down this important topic and clarify whether Murabaha is considered halal or haram. Murabaha is a specific type of trade finance contract commonly used in Islamic banking. It involves a seller, often an Islamic bank, purchasing a commodity or asset and then selling it to a buyer at a disclosed price plus an agreed profit margin. This setup is structured as a sale rather than a loan, which is significant because interest, known as riba, is prohibited in Islam. One key reason why Murabaha is generally considered halal is the nature of the contract itself. It is a sale contract, not a loan. The bank first buys the asset, taking ownership and assuming risk before selling it to the client at a marked-up price. The profit is fixed and agreed upon upfront, which clearly differentiates it from interest-based lending. Transparency plays a vital role in Murabaha transactions. The seller must disclose the original cost and the profit margin to the buyer. This ensures that both parties understand the terms of the deal, promoting fairness and honesty in the transaction. Another important aspect is the risk and ownership involved. The bank must take ownership and liability for the asset before reselling it. This aligns with Islamic principles that state profit must be linked to risk. If the asset incurs any issues, the bank is responsible, which is a fundamental aspect of Islamic finance. Payment terms can also vary in Murabaha contracts. Buyers may have the option to defer payment or pay in installments. However, the price remains fixed and does not increase due to late payments. Some scholars suggest that any penalties for late payments should be donated to charity to avoid any association with riba. In practice, Murabaha is widely used by Islamic banks as a primary method of financing. It is especially popular for purchasing assets like homes, vehicles, and machinery. This method provides a Shariah-compliant alternative to conventional loans by structuring the transaction as a sale with a profit margin rather than as interest-bearing debt. However, it is worth noting that some scholars and critics view Murabaha as a permissible but less ideal form of Islamic financing. They argue that it can resemble conventional loans in economic effect, as the markup often reflects prevailing interest rates. Additionally, many transactions occur without the bank actually taking possession of the asset. In summary, Murabaha is considered halal when it strictly follows Islamic finance rules. The bank must own the asset before resale, disclose costs and profit, avoid interest, and not charge penalties that benefit the bank. This contract remains a practical and widely accepted method of trade finance in Islamic banking, allowing for asset financing while adhering to Shariah principles.